Oh, you guys are here. So let me start today's class by telling you a very interesting story about Jeff Bezos. So Mr. Bezos always gets a question and he gets asked that what is it about the world that is going to change in the next 10 years? He says that this question is not completely correct. What you should rather be asking me is that what in the world is not going to change in the next 10 years? For example, customers are never going to come to me and say that, hey, sell me more expensive products on Amazon. They are not going to come to me and tell me, increase the delivery time from 1 day at Amazon to 2 days. They are not going to come to me and say that give me fewer options to purchase. The point he is trying to build is that if you can understand where the world is going and what things are not going to change, that is where the business world will move. So we will apply this thought process to the automobile space and we will predominantly understand three central things. One, I will help you understand the industry landscape of the automobile sector. Second, what are the challenges and opportunities that lie in conventional and the EV segment space within automobiles? Third, I will help you build an investment framework in case you want to build your positions in some of these stocks. So let us get today's class started. So the industry overview of the auto sector can be easily understood by taking a look at three specific graphics. Take a look at this particular graphic and you will understand that India is the largest producer of 2 and 3 wheelers. It is also the largest manufacturer of tractors. So our manufacturing capabilities are very good when it comes to conventional automotive space. Take a look at the second graphic. You will see that even from a sales volume perspective, India does fairly well. Now the story changes when I show you the third graphic because this has got to do with the EV industry. The electric vehicle industry story presents a dismal picture for India. Not only the sales number are low for India, but also it is heavily skewed. For example, when it comes to four-wheelers, EVs or electric vehicles constitute only 4% of the total sales. On the flip side, when it comes to two-wheelers, it constitutes almost 50% of the EV total sales in India. This is definitely a dismal picture. So let me talk about this battle between conventional and EV space in 5 simple points that will give you more industry insights in the next section. Auto sector is a highly complex space, but understanding these 5 key points is going to help you build an investment thesis. So let us quickly scan through these points and then we will understand them in detail. The first key point that you need to understand is that there is a migration that is happening from conventional automobiles to EV. When it comes to IC engine based vehicles, what is happening is that these cause a lot of pollution. A lot of people are getting environmentally conscious. A lot of countries are coming out with laws and regulations that are promoting the use of green energy, and therefore the world is moving towards the EV or electric vehicle space. Second key point that you need to know is that the nature of auto sector is discretionary. These are discretionary products. Only when people have more money to spend, they end up buying these discretionary products. So car buying or two-wheeler buying happens due to that particular reason. So you need to understand that financing in the auto sector plays a critical role in terms of growing this industry. Third key point is that you need to understand that as nations become richer, their ability to spend on discretionary products grow, and as and when India's GDP rises, this industry is going to pick up even more. The fourth key point is that this industry needs to grapple with supply chain challenges. Assembling a two-wheeler or a four-wheeler is a highly complicated task. It requires a series of raw material that goes into creating a car or creating a bike. So therefore, dealing with supply chain challenges and building local capacity comes into the equation, and it is a necessary step. Fifth and final point is that this industry is cyclical in nature. It means that for an elongated period of time, the sales growth in this industry might stagnate, or when there is a boom period, what happens is that the industry might grow really fast. So these are some of the key points that you need to understand about the auto industry. If you understand these key points, it will help you develop your investment thesis. So now let's delve deeper and try to understand each of these points in slightly more detail, starting out with the EV or electric vehicle segment. Take a look at this particular chart. It will help you understand who is leading the race when it comes to EV, with China and Germany being the clear contenders who are leading this race currently. So this brings us to the question that what is the situation of electric vehicles in India? Take a look at this particular graphic. It outlines the recent sales figures from prominent companies in India, and the result looks very dismal. We have hardly sold many units of these EVs, so clearly there are challenges that need to be dealt with. First and foremost challenge is the financing of the EV segment, and here India is faring very well. As per a report by Niti Aayog, and it will flash on your screen, you can clearly see that the financing opportunity is a $3.7 trillion opportunity. So resultantly, this financing market is set to grow. But will this translate to more EV sales? That needs to be seen. And for this, you need to understand the point that Indian consumers are very price conscious. And right now, as per a McKinsey report, there is a $12,000 difference between a conventional IC engine car and an EV car. So the industry needs to mature, then this high financing opportunities will translate into more sale of EVs in India. Now, as the industry matures and EV prices come down, more and more consumers will avail this discretionary product. This will get an additional push by the increase of GDP in India, because in India, right now, the income levels are low, but they will grow with time. India will become richer as India exhibits more and more growth. So it is predicted that by 2026, India will become one of the top 3 automotive markets in the world. But for this story to play out, India needs to grapple with several challenges. The primary challenge being localizing their supply chain. So let us understand that point in slightly more detail. So the supply chain of the auto sector is deeply complicated. For example, imagine assembling a car. Now we need a range of raw material to build that car. This range of raw material comes from local sources also and global sources also. So India's dependence on external sources is also very high at the moment. Now the context changed completely if we are looking into the EV space, because we need to rationalize the cost structure of manufacturing an EV. So from that particular perspective, localizing the local supply chain when it comes to EV become prominently important. So let us understand if India currently has the potential of localizing this EV supply chain or not. And this particular graphic gives us a good picture. So when it comes to battery, motor and power electronics, the localization potential of India is really weak. And this is where government intervention needs to kick in. If government supports these spaces and if India is able to build local capacities, we can actually become a winner in the EV segment. You will become extremely excited that, hey, it's time for me to invest if I start seeing actions by the government in these spaces, and you might pour in a lot of money. But hold your horses, because the auto industry, including the EV segment, is highly cyclical. For reference, take a look at this particular graph. You will see that the industry boomed from 2004 to 2010. Post 2011, for almost a decade, the industry stagnated, and in some years it even fell. In 2020, a major slump in sales came, and now the industry is going back up. So this indicates very categorically the cyclical nature of this industry. So the auto industry is extremely complicated, but this simple checklist can help you become a better investor in this space. Just remember these few simple points. Point number 1, please remember that the auto industry is highly cyclical in nature, so don't get caught in a bad end. Point number 2, please be considerate of the supply chains. If the local supply chains are getting built, it's a great sign for auto stocks and you could consider taking some positions. On the flip side, if the global supply chains are getting disrupted, it's a bad sign. For example, very recently when Russia-Ukraine crisis broke out, it impacted the semiconductor industry very negatively. So be considerate about such developments. Point number 3 is that if you are investing in an auto stock, then you must check the moat of a company. For example, many people feel that Tata Motors has created a moat in the EV segment because it is creating an ecosystem of companies. For example, Tata Steel and Tata Power can supply raw material to Tata Motors at a cheaper price. Point number 4 is that you must be considerate about the local demand. For example, if the GDP is growing or if people are becoming generally rich in an economy, they would have higher discretionary income to buy automobiles. So that will help the auto stocks. So the fifth and final point is that you must be aware about some of the key ratios in the auto industry. For example, be aware about the debt to equity ratio, because auto companies are capital hungry companies. If they get caught on the wrong end of the demand cycle and if a sales slump takes place, and if these companies have a lot of debt, then it can spell trouble for such companies. Second, be aware about the inventory turnover. Inventory turnover means that how quickly a company can turn around its stock and sell it. Third and finally, you must be aware about the return on equity component of an auto stock. Because if the return on equity is high, it means that the company is using its capital productively. And in a capital hungry industry, if a company has an high ROE, it becomes a competitive advantage. I hope you enjoyed today's class, and I will see you the next time.